Lesson 10. Accounting and Financial Statements. Sumerian traders found clay tablets invaluable as they provided a means to track their financial standing, assess progress, and strategize for the future. The accounting system widely used in modern business is accrual accounting, which records financial events when they occur, regardless of whether cash has changed hands. In this system, transactions are documented at the moment they take place, rather than when payment is received or disbursed. Expected or prior payments and receipts, known as cash flows, are categorized as accrued or deferred. This approach contrasts with cash accounting, where transactions are only recognized when money is physically exchanged. Accrual accounting recognizes earnings as economic events marked by the exchange of goods rather than cash transactions. This system enables a temporal separation between the transfer of goods and the receipt of payment, allowing transactions to be completed across extended periods and distances. As a result, businesses can engage in broader and more sustained trade. Additionally, accrual accounting provides a more precise representation of a company's financial position, offering greater insight into its actual economic standing. Modern accounting techniques emerged during the European Age of Discovery, driven by the rapid expansion of trade. The foundational principles and methods of modern accrual accounting were first formally published by Luca Pacioli in his 1494 work Summa de Arithmetica, Geometria, Proporzioni et Proporzionalità. Venice, Luca Pacioli, 1494. Although these techniques were likely in development prior to that. These accounting methods, once used for managing the finances of global trade in spices like pepper and cloves, can still be effectively applied to personal finance today, yielding similarly valuable results. Nevertheless, in personal finance, it is generally more practical to use cash accounting, where events are recorded when cash actually changes hands. In this approach, incomes and expenses are noted at the moment the cash is received or paid, reflecting the actual flow of money. Financial decisions lead to transactions, actual exchanges where something is bought, sold, invested, or borrowed. In a market economy, every trade involves a trade-off, where something is given up to obtain something else. Each transaction thus involves at least one item given up and one item received, with two flows in opposite directions. Accounting tracks these transactions, recording both what has been acquired and what has been surrendered to obtain it, what flows in and what flows out. In business, transactions are tracked in accounting journals and ledgers as they happen. For personal finance, most transactions are recorded in a checkbook, with additional details provided by bank or investment account statements. These records are then summarized into financial statements to present the information in a more digestible form. The process of bookkeeping involves documenting the specifics of each transaction, what was exchanged, how it happened, and the amounts involved. With the introduction of accounting software, traditional bookkeeping methods have become less necessary, much like other outdated tasks, though critical human judgment is still required. The real value lies in the financial summaries that emerge from all the recorded data, the income statement, cash flow statement, and balance sheet. The income statement provides a summary of earnings and expenditures over a specific period. In a business context, income represents the value of goods or services sold, while expenses reflect the costs incurred in generating that income, with the difference representing profit. In personal finance, income consists of wages or salary earned, as well as interest or dividends received, while expenses account for the costs of daily living, such as housing, food, and utilities, essentially the costs needed to maintain oneself while earning. Therefore, The income statement acts as a gauge of your earnings and the cost of sustaining your life during that time. The result is personal profit, which, if saved and invested, contributes to building your wealth. The income statement clearly illustrates the balance between your income and expenses. When income exceeds expenses, there is a surplus, which can be saved or used to increase spending, thus raising expenses further. However, if expenses surpass income, a deficit occurs, which needs to be resolved. If the deficit persists, it leads to the accumulation of debts, unpaid bills, that will need to be addressed eventually. Over time, operating with a deficit is not sustainable. The income statement also provides valuable detail. It allows you to identify which expenses take up the largest portion of your income and which have the most or least impact on your financial outcome. If your goal is to reduce expenses, the statement helps you pinpoint which costs would have the biggest effect on freeing up more income. Similarly, if you're looking to increase income, you can assess how much additional income would contribute toward covering your expenses. For example, look at IT specialist Sherry's financial situation. Sherry also had car payments totaling $3,700 and student loan payments amounting to $10,680. Each student loan payment covers both the interest expense and a partial repayment of the principal. The interest represents the cost of borrowing, reflecting the expense of having the car and receiving an education. However, the repayment of the loan itself is not considered an expense, as it is merely returning money that was originally borrowed. Breaking down Sherry's living expenses in more detail and adding in her interest expenses, Sherry's income statement would look like this. Sherry's disposable income, what remains after taxes are accounted for, amounts to $29,020. With this information, she gains a much clearer understanding of her financial situation. She can now see that living expenses take up the largest portion of her income, with rent being her biggest single cost. If Sherry aims to reduce her expenses, finding a more affordable place to live would likely have the greatest impact on her finances. Alternatively, she could consider making several smaller adjustments across different categories to reduce costs gradually. For instance, cutting back on entertainment, clothing, or travel might free up some funds. Whatever strategy she chooses will be reflected in her income statement, which serves as a useful tool for tracking her financial decisions over time. The cash flow statement tracks the movement of cash into and out of your finances, showing where the cash came from and where it went over a specific period. Unlike the income statement, which focuses on income and expenses, the cash flow statement may also include cash flows that are not directly related to income or expenses. For example, cash flows could involve the repayment of a loan you made, repaying money you borrowed, or using cash in transactions like buying or selling an asset. The cash flow statement is crucial because it highlights your ability to generate liquidity, in addition to showing your net income. Liquidity refers to how easily you can access cash, and it holds value. Having excess liquidity can allow you to sell or lend it, generating extra income. On the other hand, a lack of liquidity may require you to purchase it or borrow, leading to additional expenses. Looking at Sherry's situation, she has 2 loan repayments that are not expenses, and so are not included on her income statement. These payments reduce her liquidity, however, making it harder for her to create excess cash. Her cash flow statement looks like this. Like the income statement, the cash flow statement becomes more insightful when categorized into different types of cash flows based on their sources and uses. Cash flows related to income and expenses fall under operating cash flows, which reflect the money earned and the costs incurred to generate that income. Loan repayments, on the other hand, are financing cash flows, representing payments toward assets or investments intended to enhance future earnings, such as a car or education. While this example doesn't include any, cash flows from investing could also be present, arising from the purchase or sale of assets. Free cash flow refers to the remaining cash available for investment or financial decisions after covering operating expenses and debt repayments. It is determined by subtracting total debt payments from operating cash flow. The primary distinction between the three types of cash flows, operating, investing, and financing, is their regularity. Operating cash flows occur consistently, as they stem from income and expenses or daily financial activities, making them a recurring part of each financial period. While the exact amounts may vary, these cash flows are expected in every cycle. In contrast, investing and financing cash flows are less predictable, as they often result from one-time or infrequent transactions, such as purchasing assets or repaying loans. Sherry's cash flow statement provides a clearer picture of how liquidity is managed and where it could be improved. If she aimed to increase her available cash, reducing or eliminating her loan payments would make a significant difference. Without those obligations, her net cash flow would rise by over $6,000. Whether in business or personal finance, evaluating one's financial position requires a balance sheet. Also known as the Statement of Financial Condition, it provides a snapshot of assets and liabilities at a specific point in time. Unlike the income or cash flow statements, which track financial activity over a period, the balance sheet presents a momentary overview of financial standing. The balance sheet outlines assets, liabilities, debts, and equity, net worth, along with their respective values. In a business context, assets represent resources that generate income, while liabilities and equity reflect the funding sources for those assets. Consequently, the total value of assets must always match the combined value of liabilities and equity. This fundamental principle is captured in the classic accounting equation: assets equals liabilities plus equity. In business, the accounting equation is as fundamental as gravity. It must always hold true. Every asset must have been financed in some way, whether through debt or equity, and the total value of that financing must match the value of the assets acquired. This is why it's called the balance sheet. It ensures that assets are always equal to the sum of liabilities and equity. In personal finance, assets represent resources that can be converted into cash when needed, particularly to cover debts. Since assets are used to settle financial obligations, their total value should ideally exceed the amount of outstanding debt. In other words, you should have more financial resources available than you owe to maintain stability. Your net worth is the difference between what you own and what you owe. In simple terms, it represents the portion of your total assets that truly belongs to you after all debts are accounted for. It reflects the value of what remains once financial obligations have been settled. This concept is captured in the fundamental accounting equation. Assets minus debt equals net worth. Your net worth represents your financial stake in your own life, essentially, the portion of your assets that you truly own. Just like in business, a personal balance sheet must always balance. This follows the fundamental equation: assets minus debts equals net worth, which can also be written as assets equals debts plus net worth. Sherry can create a straightforward balance sheet to assess her financial standing. Her assets consist of her car and savings account, while her liabilities include her car loan and student loans. Let's examine the financial situation of recent college graduate Patrick by creating a simple balance sheet. Patrick has two assets, his car and his savings account, but he also carries two debts, a car loan and student loans. Patrick's balance sheet provides a clearer view of his financial situation, but it also reveals an unsettling reality. He appears to have a negative net worth. Negative net worth occurs when the total value of liabilities exceeds the value of assets. This means that his assets aren't worth enough to cover his debts. Since debts are obligations, this situation is cause for concern. In business, when liabilities exceed the assets available to cover them, the company faces negative equity and is essentially bankrupt. In this case, the business may close down, selling its assets and giving whatever is left to creditors or lenders, who will have to accept less than what they are owed. More often, the business continues to operate under bankruptcy, working out a plan to repay creditors, though possibly under more favorable terms. Creditors and the law typically allow these adjustments because they prefer receiving full payment at a later date, rather than accepting a reduced payment now or not getting paid at all. In personal finance, personal bankruptcy occurs when debts surpass the value of assets. In this scenario, creditors may allow the individual to continue earning income, with the hope of repaying the debt later or under more manageable terms. Often, the individual will be required to liquidate, sell, some or all of their assets to settle the debts. Because debt represents both a legal and economic obligation, there are laws governing bankruptcy that vary by state in the United States and from one country to another. While debt forgiveness is mentioned in the Old Testament, historically, bankrupt individuals in many cultures faced severe consequences, including death, mutilation, enslavement, or imprisonment. The use of another person's property or wealth is a significant responsibility, making debt a serious commitment. However, Patrick's situation isn't as bleak as it may seem, because he possesses an asset that isn't reflected on his balance sheet: his education. It's not listed as an asset because, like any resource, its value comes from how useful it will be, and that usefulness hasn't been realized yet. It will unfold over time. The value of his education will manifest in the future, depending on how he leverages it to boost his income and build wealth. While Patrick knows what he paid for his education, its true value isn't simply its cost. It's the potential return it can generate for him as he applies it in the years to come. Recent studies demonstrate that a college education has significant economic value, as college graduates typically earn more over their lifetime than those with just a high school diploma. Estimates suggest that the earnings difference can amount to around $1 million. Sandy Baum and Jennifer Ma, Education Pays: The Benefits of Higher Education for Individuals and Society. Princeton, NJ, The College Board, 2007. If Patrick assumes that his education will yield an additional $1 million in income over his lifetime, and he includes this potential asset on his balance sheet, his financial picture would look quite different. In conclusion, it is clear that the only factor contributing to Patrick's negative net worth is his student loan. The student loan makes his liabilities exceed his assets, but if it were paid off, his net worth would become positive. Considering that Patrick is just beginning his adult earning years, his financial situation seems quite manageable and typical. See you in the next lesson.